Today, I want to talk about mutual funds and why I don't use them and why I don't like them. Now, I'm not saying that all funds are bad. There are over 4,000 funds out there. As a matter of fact, in a way, this is kind of a difficult discussion because I grew up in this industry back in the 80s, being taught to sell mutual funds. But I was lucky. In the late 90s, when I was selling mutual funds, I started looking at the holdings of my value funds. Now, those are funds that are supposed to buy things that are low in price, that have a dividend, that has a history of consistency and in value, that they're not trying to grow a growth asset, the value of their company. What I found when I looked at those mutual funds at the time was they were full of dot-coms. Remember, that was the dot-com era. That was when everything's coming up roses. If you get on the internet, you're going to be a millionaire. A dot-com company. They didn't have to have as much physical assets. They could operate in different offices all over the place. They didn't even have to have an office. It would save you money. You were going to make $1 million. As it turned out, most of them went under between 2000 and 2003. It's called the dot-com bust. I got out of the way of most of that, but that was my first experience with a market that busted. Not that it went down, but that a whole group of assets busted. We saw it again in 2008. That one I managed to get out of the way of. And getting out of the way of is kind of the issue we're going to talk about today. Now, in my portfolio, I have a closed-end fund and 2 ETFs. The total cost of all the investments in my portfolio is 0.02%. That's it. Why is that? Because the more expense you have in your portfolio, the more your portfolio has to return to you for you to get ahead. And I don't like being the last person served at the financial dinner table. Let's take a look at a couple things. And I'm going to share screen here. And you're looking at the T. Rowe Price Blue Chip Advisor Class Fund. Now, this fund is designed for advisors to sell. That's what it's for. It's got a fee, like all of them. It's got an expense ratio of 0.95. It even has something extra special for the advisors, and that's called a 12B1 fee, and that's 0.25% more. So the total expenses in this fund is 1.2%. And on average, I find that the average person spends between 0.95% and 1.05% on their investments. So let's take a look at this. What have they got here for us? Well, there's your gross expense ratio, 0.95%. Right there. There's your gross expense ratio. There's no distribution yield. They decide how much you're going to get on an annual basis if you're going to get anything. And let's take a look at risk and tax analysis, because this is where the rubber meets the road. I want to look right here. Portfolio statistics. Now, the beta is 1.06. In other words, that mutual fund is taking 0.06% more risk than its benchmark index, whatever that happens to be. Its upside capture, this is how much money they make when the market goes up, is 90.51%. In other words, if the market goes up 20%, you're going to get 16 of it. Give or take 90% of that. Slightly more than 16. So you have $100,000, or you have $100,000, and the market goes up 20%, you're going to have 116,000. That's not the problem. Look at that rate right there, the downside capture rate. When the market goes down, this fund goes down 119.26%, call it 120 for my simple mind. So in essence, if the market loses 20%, you're going to lose 20% more than that. 20% of 2% of 20% of 20% is 4%. So if the market goes down 20%, you're going to lose 24%. I don't think that's a good deal. I just don't. Because if they're doing their job, it would seem to me that they're going to get out of the way. But growth funds seldom get out of the way. I give you Cathie Wood's in the last 2 years. The ARK funds, ARKK. How have they done? Take a look. They didn't get out of the way. They didn't get out of the way to the point where you could have gotten the same return with almost half the risk by getting a consistent 8.86% return. And I've proven that in another video. You might want to take a look at risk and volatility and what I said about the ARK funds in my separate video. So I've got an upside capture rate of 90.5. I've got a downside capture rate of 119.26. That's not a great deal. I've got a 12B1 fee right there. Do you see that? There's a 12B1 fee right there. That means they're paying your advisor an extra 0.25% for selling the fund. So who's first in line? When this fund goes down 120% of what the market went down, they still paid your advisor. They still got their own funds. Now, let's take a look at another fund. This is an ETF. This is a very different ETF. It's not a blue chip growth fund. This is a fund which follows the Dow Jones Industrial Average ETF. It's $28.1 billion. That's a lot of money. It's got an expense ratio of 0.16. That's not too bad. Matter of fact, in preference to 0.95 and 0.16, I'll take the 0.16. Thank you very much. But it's got a yield of 1.191%, 1.92%, give or take. But if I go over here and I ask online, what's the yield of the Dow Jones Industrial Average? I get 4.77%. So what's happened to the extra 2% plus in there? Where's that going? You see, you're not first in line. As a matter of fact, you're last to be served at the financial dinner table. And in some years, like last year, you don't get anything. That's why in my portfolio, the total expenses inside my portfolio is 0.02%. I don't use financial products except in specific instances for specific reasons. One in this case is gold. The others are generally higher yield with a lower risk in areas where I can't buy individual stocks or preferreds or bonds to get what I want. Last year, my portfolio was up about 3.54%. I'm taking less than 3/4 of market risk. I don't use financial products. You don't have to either. And very often, even your 401ks will allow you not to use financial products. Now, the next time you talk to your advisor, ask your advisor, okay, what's the upside capture and the downside capture of this fund? And I'll bet you most of the time your advisor won't know. They'll have to go look it up because they aren't taught to look that up. Make sure that your funds have no 12B1 fees. know what fees you're being charged, know how much your advisor charges you, and know what the S&P 500 does every year and what you did as a result. The worst thing in the world is to take 104, 105, 106% of market risk and get 90% or 80% or 70% of market return. If you like this video, please push the like button. Subscribe to The Laughing Retirement. Take a look at all the videos. We're going to talk about life in Italy. We're going to talk about investments. We're going to talk about retirement. I'm Chip Stites. It's been my pleasure. Oh, and don't forget to join the Laughing Retirement community on Facebook. I'm Chip Stites. It's been my pleasure, as always.